Okay, good morning everyone. Welcome to 24/7. My name is Niharika Walia and I am with you with the area of accounting and financial management for bankers. So let's begin with the session today. We'll be talking about a few questions on company accounts further. So here comes the first question. This particular question relates to an equipment that is being purchased. This is basically a journal entry. A journal entry to record the purchase of an equipment for 2 lakh of cash and balance of 8 lakh in due in 30 days. We're not paying it yet. We'll be paying it later on. So how do we record this particular portion, everyone? It says the debit the equipment with 2 lakh and credit the cash with 2 lakh because we're paying 2 lakh in cash right away. Or we should write the equipment as 10 lakh and credit the cash with 2 lakh and creditors with 8 lakh, debit the equipment with 2 lakh and creditor with 8 lakh, or debit equipment as well as cash with 10 lakh. Currently, you can see we have bought the equipment for 8 lakh, for 10 lakh rupees. It's basically 10 lakh overall now. So in this case, when we have purchased this particular asset, it is equipment is worth rupees 10 lakh. While out of that, we have paid 2 lakh right away. 8 lakh is still pending. So it would be like this. 10 lakhs would be on the debit side, 2 lakh for cash and 8 lakh for creditors. Here comes the next question, everyone. Sales are equal to cost of goods sold plus GP, cost of goods sold minus GP, GP minus COGS or purchases plus GP. Sales are equal to. If we talk about sales, it would be basically sales is equal to whatever your cost would be. The cost plus we add up something. Now we cannot sell it at the par. So that means we sell it at a profit. So it would be cost of goods sold plus GP. That is something which we'll define as sales. So sales are equal to COGS plus GP. So the correct answer is A, COGS plus GP. Next question. Which of the following is not the limitation of financial statements? Ignore qualitative aspects, personal bias, ignores price level change, or provide information about the profitability of the business. Which of the following is not the limitation? It ignores the qualitative aspects, correct. It does not include any of the qualitative aspects at all. We cannot record loyalty of a particular person. Can we record the emotions of a particular person? No. Then personal bias is also there. People can manipulate the accounts as and when they want because they're looking at from their point of view, not from the point of view of the government, right? So it ignores price level change. Again, this also happens. We cannot include the price level changes because price changes every single day. If we start recording things at the price level, then we cannot continue recording at all. Provides information about the profitability of the business. That's a merit. That's not a demerit. So in this case, the correct answer is D. Provide information about the profitability of the business. That's a merit. Then next question. The subheadings are non-current liabilities are long-term provisions, long-term borrowing, deferred tax, or all of the above. Non-current liabilities includes all of these. That means it includes the long-term borrowings and as well as provisions because these are those provisions which are for more than 1 year. And then we have deferred tax liabilities. Deferred tax liabilities is basically a position where we have to pay more tax tomorrow while we are paying less tax today. That is what we define as deferred tax liability. The problem is the timing as well as the permanent difference. Timing difference as well as permanent difference that occurs in the working of the person. That is how we can define the timing as well as the permanent difference. When we have timing difference, that means the income tax department says that you need to record it. The income tax department says record it, while the Companies Act says don't record it. Or if the Companies Act says record it, income tax disagrees. When such a scenario occurs, that is where we have deferred tax assets or liabilities. If it's a liability, it would be shown in the non-current liability. If it's an asset, it will become a part of deferred tax assets. So in this case, the right answer is all of the options. Next question. Calls in advance is to be shown under the heading of current liabilities, current assets, current liabilities, and current assets, or none of the above. If we talk about calls in advance, that means people have paid their share capital, share call basically, before we call it from them. That means before the amount becomes due, the people have paid their amount. So in this case, what will happen? So the correct answer in this question would be calls in advance would be shown under the heading of it's basically a liability. People are paying in advance, so we are bound to respond to them, isn't it? So when we talk about the calls in advance, it would be a current liability because we are going to give them that particular share later on. Not today, but yes, we'll be giving that share to them in the upcoming period. Accumulated dividend arrears on preference shares is shown in the company's balance sheet as current liability, contingent liability, commitments, or short-term provisions. Accumulated dividend arrears, that means we are supposed to pay dividend to the preference shares, but normally we are not bound, even depending upon the particular shares that the preference shares would have taken. It would depend upon the situation that whatever dividend we are supposed to pay to them, whether we are going to pay this year or not. So when we have this particular scenario of accumulated dividend, there is no foundation that we are supposed to pay in any case. So it's basically a commitment, right? So we note it as a commitment. It is not taken as a current liability, it is not taken as a part of contingent liability, and yes, it's not even a provision. Provision can include provision for tax. So it is commitments in this case. Next question. Comparative balance sheet provides the summarized view of the operations, presents the financial position of the firm, presents the change in the various items, or none of the above. If we talk about the comparative balance sheet can be stated as something which tells us about one thing, that is, it presents the change in the various items of the balance sheet. Whatever changes are occurring in the balance sheet, it would be shown here. Next, operating expenses includes provision for doubtful debts, of office and administrative expense, selling and distribution, or all of the above. If we talk about operating expenses, operating means the day-to-day expenses that are happening in the organization. So doubtful debts are a part of it. Selling is also a part of it, because we try to sell the various goods now. So when you're trying to sell, we are trying to operate in the best possible way. So it would be either provisions for doubtful debts, or then is office and administrative expenses are also part of it. Selling and distribution is also part of it. So the correct answer is all of the above. All of these would be a part of it. So the next question is, a foreign currency transaction should be recorded on initial recognition in reporting currency, foreign currency, based upon fluctuations, or none of the above. So when we talk about the foreign currency, it is based upon what? If we have a foreign currency, it would be based upon whatever the value is in terms of our reporting currency. If we talk about the foreign currency, for us, dollar is a foreign currency while rupees are reporting currency. So everything has to be noted in terms of rupee now. So that is what we define here. So we have to note down things as per our rupee. That means the foreign currency transactions are basically those transactions which should be recorded on initial recognition in the reporting currency by applying to foreign currency amount the exchange rate between the reporting currency and the foreign currency at the date of transaction. So in this case, what's happening is, in terms of reporting currency, we note down whatever is happening in terms of those goods and services. So when we talk about the goods or services which we would have taken from a foreign land or a foreign place, then they would have done that particular transaction. Normally it happens in dollars. It can be any other currency as well, in terms of pounds. It can be in terms of yen or any other, like dinar. So when we are trying to do it in that case, whenever we are preparing our books of accounts are not based upon different foreign currencies. We are preparing things in terms of rupee only now. So if we are keeping it in terms of rupees, so we'll record it in terms of rupee only. So we will convert that particular dollar into rupees in order to find that particular transaction. Now, the next question, the revenue expenditure is redirected to the following accounts: profit and loss account, balance sheet, partly to the balance sheet, partly to the P&L, or trading account. So, revenue expenditure can be redirected to the following accounts. Revenue expenditures are taken towards the area of P&L because it's a nominal account which records all the expenses as well as all the incomes. So, the correct answer is P&L account. So the correct answer is A, profit and loss account. The marketable securities appear in the company balance sheet under the subhead of current investments, non-current, intangible assets, or short-term loans and advances. If we talk about the marketable securities appear in a company's balance sheet under the subhead of marketable securities are basically current investments. The investments which can be used in terms of current investments are those investments which can be used to find out the particular situation there. In terms of current investments, we are trying to sell it within the period of next 3 months, not more than that. So then we